Joining us now is Steve Tananbaum, the founder and CIO of GoldenTree Asset Management. Steve, good to see you, sir.
It's great to be back.
What a crazy week, a crazy year. How are you looking at things in 2026?
So a week ago, I think IMF, or a few days ago, raised world growth. We've been constructive, and then there was this anxiousness here. So we've been constructive and see nominal growth of 5 to 6%. And to us, the issue is the mix between real and inflation. And that comes back to affordability. Do people feel like they have more to spend or less to spend in their pocket? And this is going to be a bipartisan issue. And that's where I think the conversation is going to be refocused on. It was last year, or rather last week, with credit cards on caps. There's been more focus on that. There's been more two-way discussion of what that can look like. You look at energy, a thought to keep prices down, and housing. How do we increase the velocity of housing? Now, I mentioned these in terms of the prospects for 2026 because it comes down to who's impacted, who's going to have good margins, who's a beneficiary of this, and who is not going to be a beneficiary of this. Intuitively, if you're going to be capping your profits, you would think that credit card issuers would be more challenged today than they were before this was announced. On the other hand, if you're a supplier to housing, you would think you would be a beneficiary, and that's also off a relatively low base. So that seems like they're good prospects there.
I'm so pleased you've gone in this direction. I think it's so important because the situation you describe has been a societal issue for a while, a political problem for a while, but markets have been somehow insulated from this. And now the president is putting more focus on it in a midterm election year. It's about to become a market problem and also an opportunity in the way you describe it. Are you allocating money to some themes against others with all of this in mind?
Absolutely. Housing, we're focusing on housing. We're watching financials, particularly the credit cards, play out. Who are going to be the winners and losers? What's it going to look like? And are there other ramifications to get more money into people's pockets? And so that's what we're focusing, how that's going to work.
So in other words, you're going to buy now, pay later types of companies, invest in alternative types of lending. Is that kind of the idea?
You know, it's a great question. If you think of a 10% cap, those pretty much are like double, triple that. So because they're going with people who would be subprime bearers. If you aren't subprime, you're not going to have the buy now, pay now later. That's not their target group or prime. So that wouldn't be my first choice because I would think that they would have more negative selection, but who knows? Because it's hard to react because we don't know what it's going to look like. What I found interesting is before there was denial, it won't happen, and now there's more of a two-way flow. Okay, what can we do to address this issue?
I just wonder how you invest in fixed income. You're traditionally in distressed debt, distressed assets at a time where there's very little distress.
Absolutely.
And you have potentially higher inflation in addition to higher growth, and you have a flight into income products. How do you decide to invest with such high valuations? So
first thing is it's not clear that inflation's higher. You know, it looks, if you look at the last couple of data points, they seem to be somewhat subdued. Whether they become higher, who knows? But I think that's one of the themes of this year is to watch that. We're constructive that inflation's more under control, and you're going to see the composition of growth be much greater than inflation. In terms of when valuations are tight and growth is, let's just say, 2% or more, it's a bad neighborhood for fixed income, particularly high yield, below investment grade, and you usually do not earn your coupon.
So you buy stocks?
There are some stocks that are more interesting. If you look, you could look at something like an MGM, where the debt markets would finance the entire market cap of MGM. You look at Kinova, a pharmaceutical company, the old Mallinckrodt Endo, same thing. I don't think either of those management teams want to go that way. You look at Comcast, which is too large to finance, but at 5 times EBITDA and a 13-14% free cash flow, and pretty much an equal debt to equity split now. So it's a pretty reasonable credit. The debt markets would finance 100% of that. So there's certainly a relative value opportunities, and certainly equity does better with this profile than debt.
Steve, when you talk about potentially finding places to invest because of policies in America, you're talking about as if these policies are already done. The president's just floating some of this stuff on truth. Do you really think a lot of this can actually get done in America? Policies first floated by the very left wings in the United States, Bernie Sanders, Elizabeth Warren.
You know, it's a great question. So are we reacting? It's more like what we have confidence in, what we have no confidence in, and how that's priced. And so if it's priced as if it's a done deal, which it's not, and it's not priced that way either, we tend to be shy. When it's priced as if it's not a done deal, but if it's priced like it's a done deal, but it's not done, and we think that even if it occurs, it could be interesting, then we're going to look at it. In distress, probably the most interesting area of distress is actually in a different part of the credit cycle, which in distressed debt, which is in the debtor in possession market, where you had First Brands, which was a industrial roll-up, was a fraud. It went bankrupt, and then they needed financing to operate in bankruptcy, and that's known as a debtor in possession financing. That financing usually is very safe, and they raised about a couple $2 billion, and it turned out that it was not safe. In fact, it lost 80% of its value. Very unusual, and with fraud, you don't know. And in this case, the whole market has come off significantly. So that's been an interesting part of the market. It reminds me of what happened with Credit Suisse when it was bought by UBS, and they gave equity a return, but blanked the junior debt. And the junior debt of the European banks sold off 20, 30 points. So I'm seeing a similar type of opportunity in terms of that market selling off.
Steve, super smart. Just one final question. You just touched on something important, how one company can basically sour the whole environment and very quickly. What happens if OpenAI gets into a bit of trouble later this year? What would it do to private markets?
So you're asking if OpenAI becomes Ask Jeeves. I mean, that's kind of the question, right? And it wouldn't be surprising looking back. There certainly seems to, I think that if it's you pick the wrong horse issue, then I think it's going to be fine. There'll be winners and losers. If it turns out that the enthusiasm or the hope doesn't match the reality, and you've seen that, for instance, it's further along with EVs, where the reality hasn't matched the hope, you're going to have a lot of write-downs.
Steve, super smart, very thoughtful. One of those conversations here in Davos I'll be thinking about for quite a while over the next few weeks.
Completely, because it's all about relative valuations and expectations, and fear is a frothy opportunity for people who are interested in debt. And when you have such enthusiasm, well, you might want a little bit more of the equity, and that certainly is something underpinning a lot of the conversations we're having.
Steve Tananbaum there, the GoldenTree Asset Management founder and CIO.